This isn't a rally, it's a stress signal. Silver above $51 an ounce is not excitement, it's tension, because prices this high are supposed to slow buyers down. Instead, demand is digging in. And that contradiction is the first warning you're supposed to notice. If you use money, save money, or plan your future with money, this is already your problem. By the end of November 2025, silver is holding above 51. Gold is sitting near 4,162, not spiking, holding. That stability at extreme levels is rare, and it's happening while the world's largest banks are moving their targets higher, not lower. JP Morgan Private Bank now sees gold at 5,300. Bank of America says 5,300. UBS didn't jump early. It kept revising upward again and again until it had no choice but to follow the price. But here's the part nobody is saying out loud. When institutions agree like this, they're not chasing upside. They're adjusting to something breaking underneath. And silver is where that break shows up first. Not loudly, quietly, systemically, because the price isn't the real story. What's driving it is, this didn't start as a silver story. That's what makes it easy to miss. On the surface, the event looks simple. Precious metals are holding at unusually high levels. Banks are revising forecasts upward. Investors are paying attention again. But that's only part of the picture, because when you line these moves up, they don't behave like a normal cycle. They behave like a response. Silver isn't rising because of hype. It's rising alongside gold, but for different reasons. Gold reflects confidence breaking at the top of the system. Silver reflects pressure building underneath it. One is monetary, the other is industrial. And right now, both are moving at the same time. Notice what's missing from most coverage. There's very little discussion of why silver refuses to cool off even after crossing $50. No real explanation for why banks aren't calling this a peak, and almost no focus on what sustained prices at these levels actually require. So here's the question that reframes everything. What happens when a metal that's both money and a critical industrial input starts behaving like it's scarce? Because once that line is crossed, price stops being opinion. It becomes a signal, and the system has to respond. Silver isn't rising because investors suddenly love it again. It's rising because it's being used up. Here's the claim that changes the frame. This market isn't tight because of speculation. It's tight because supply is structurally failing to keep up with real demand. And the proof isn't abstract, it's physical. The silver market is now in its 5th consecutive year of structural deficit. That means more silver is being consumed than produced, year after year, not on paper, in reality. According to industry confirmation, above-ground silver stockpiles are being steadily drained to meet industrial demand. At the same time, demand from artificial intelligence systems and military production is accelerating. But that's not the main driver. The real pull comes from solar energy. Silver use in solar panels is exploding. Current demand sits around 240 million ounces. Projections show that number climbing toward 450 million ounces by 2030. That's nearly half of all silver mined globally, consumed by a single industry. Notice what's missing. There's no corresponding plan to double mining output. No fast switch that brings new supply online. Silver mines take years to develop, and most silver isn't mined alone. It's a byproduct. So when demand rises like this, price isn't negotiating, it's rationing. And this is only the first pressure point. The next one is closer to the center of the financial system. This is where the situation stops being theoretical and starts accelerating. Because when supply can't respond, markets look for relief somewhere else. And right now that relief is supposed to come from monetary policy. But it isn't coming. The Federal Reserve is moving toward a moment it's never had to navigate before. Markets are pricing in rate cuts with expectations heavily tilted in that direction. But inside the Fed itself, decision-making is no longer unified. There is now a real possibility of a tide vote at the policy level, and here's the abnormal part. There is no clear rule for what happens if that tie occurs. In that scenario, rates don't move, not because the economy is strong, not because inflation is solved, but because the system can't agree on what to do next. Even the Fed chair doesn't have the authority to override that deadlock. This is where the story flips. A central bank that can't act becomes a source of instability instead of stability. And markets don't wait politely for clarity, they move preemptively. Historically, when monetary policy freezes under pressure, capital looks for assets that don't require permission to function. That's how gold behaves. And increasingly, that's how silver is being treated. What was once considered volatility is starting to look like repricing, and the pace is about to change. Now watch how fast this escalates. Because once confidence weakens at the policy level, stress doesn't stay abstract. It shows up in mechanics. And in the silver market, one of the most basic mechanics just started to fail: price agreement. Dealers and wholesalers are no longer relying on the same reference price. Traditional spot charts that retail investors follow are being quietly abandoned. Instead, pricing is shifting toward direct exchange data. At one point, the spread between those two systems widened to nearly $2 per ounce before partially closing. That gap shouldn't exist. In a healthy market, spot price is a shared reality. One number, one reference. But that's no longer the case. Here's why that detail changes everything. When refiners and wholesalers stop honoring the same benchmark as the public, price discovery fragments. What you see online stops matching what metal actually trades for in bulk. And when that happens, liquidity becomes conditional. This kind of breakdown isn't new historically. It shows up before physical shortages become obvious, before headlines change, before the public understands what's happening. Notice what's missing again. There's no announcement, no alarm bell, just quiet adjustments behind the counter. And those adjustments are forcing the next bottleneck into view. Because when pricing fragments, the flow of metal slows, and that's exactly where the system starts to choke. The next failure isn't financial, it's operational. As prices pushed past the low 50s, something unexpected happened. The public started selling silver back into the system all at once. Not bars, not coins, scrap, jewelry, old alloyed silver, and the infrastructure wasn't ready. Refineries are now running 7 days a week, and it's still not enough. The volume of scrap silver flooding in has overwhelmed processing capacity, creating backlogs measured not in days but in weeks and even months. Silver is arriving faster than it can be refined back into usable form. Here's the contradiction. On paper, silver is everywhere. In reality, it's stuck. Dealers can't convert inventory back into cash because refineries can't take it. Capital gets trapped, storage fills up, cash flow dries out. This is where the pressure becomes visible. Some shops have been forced to stop buying certain forms of silver entirely, not because they don't want metal, but because they physically can't move it once they have it. That's not normal behavior in a rising market. And once liquidity breaks at the refinery level, it doesn't stay contained. It cascades outward, into retail, into premiums, into who can sell and who suddenly can't. And that's where the real divide begins. What happens next looks small, but it hits hard. Because once refineries clog, the market starts making choices. And those choices create winners and losers almost overnight. Silver didn't become illiquid across the board. It fractured. Refineries began prioritizing what they could process fastest. Pure silver, standardized products, everything else was pushed aside. Sterling silver, 90% silver, old coins, alloyed forms. Suddenly dealers had no exit, no place to send it, no way to recycle capital. So retail behavior changed fast. Shops stopped buying certain silver not because it lost value, but because it lost flow. People walked in holding silver at record prices and were told no, not tomorrow, not next week. Just know that's the mini crisis. Price says one thing, liquidity says another, and when those two separate, stress builds quickly. Now stack it: refinery backlogs, dealer cash trapped, public confusion, rising premiums on clean silver, falling bids on everything else. This is what a system under pressure looks like, not collapse, compression. And the question that matters now is simple. What happens if this doesn't clear? Now bring this closer to you, because this isn't happening in charts or policy rooms. It's happening at counters, in stores, and in everyday decisions. If you try to buy silver right now, you're feeling it. If you try to sell certain types, you're feeling it even more. Prices are high, but availability is uneven. Some products are gone. Others come with premiums that don't make sense on paper. And if you're holding older silver, jewelry, or circulated coins, you may discover something uncomfortable. The price is up, but the door is closed. That's not theory. That's lived experience. People are walking into shops expecting liquidity and walking out confused, not because silver failed, because the system around it did. And this is where psychology kicks in. When people realize they can't move assets when they want to, behavior changes fast. Buying accelerates. Selling becomes urgent. Fear replaces strategy. If this feels familiar, say so in the comments. Because when ordinary people start noticing frictions like this, it means the stress has moved out of institutions and into daily life. And once that happens, it doesn't quietly reverse. The next layer explains why this keeps repeating, no matter who's in charge. At this point, outrage doesn't help. Understanding does. What you're watching isn't a silver problem, it's a system design problem. Modern markets are built for efficiency, not resilience. They assume smooth flows, constant liquidity, and predictable behavior. When any one of those breaks, the system doesn't adapt. It narrows. Incentives explain everything. Refineries prioritize throughput, not balance. Dealers protect cash flow, not fairness. Institutions hedge exposure, not outcomes for the public. No one is acting maliciously. They are acting rationally inside a fragile structure. Here's the unsettling insight. The system only looks stable when participation is passive. The moment people act at scale, buying for protection or selling out of fear, the mechanics seize up, not because of scarcity alone, but because coordination fails. That's why these moments repeat across history. Different assets, same pattern. Pressure builds quietly, signals get ignored, then friction appears where no one expected it. This is why silver keeps surfacing in these transitions. It sits at the intersection of money, industry, and trust. When all three are stressed at once, silver doesn't just rise. It exposes the limits of the system managing it. And those limits are about to be tested again. From here, the path splits, and neither direction is calm. One possibility is relief. Refinery backlogs clear. Supply chains loosen. Prices pull back just enough to calm nerves. The system buys itself time, not resolution. Time. In that scenario, silver stays elevated, volatile but contained. Stress remains, but it's managed. That's what stabilization looks like now. The other path is momentum. Demand stays high, industrial consumption keeps rising, public confidence doesn't return, and every delay reinforces the same lesson: liquidity is conditional. In that case, price doesn't wait for consensus, it moves to force one. Here's the key detail. Silver is already holding above levels that used to trigger sell-offs. That tells you something has changed. Markets aren't debating value anymore. They're responding to pressure. So the question isn't whether silver goes up or down next week. It's whether the system can absorb what's already in motion. Because once participants believe the answer is no, behavior shifts fast. And when behavior shifts, the next move usually arrives before the explanation. Here's the insight that ties all of this together. Silver didn't change. The system around it did. when prices rise but liquidity fractures, when supply exists but can't move, when institutions adjust quietly instead of explaining loudly. That's not a market cycle. That's a stress test. This story was never just about metal. It's about what happens when real assets collide with fragile systems. Silver is simply where the pressure became visible first, and once you understand that, you start noticing the same pattern elsewhere. Different assets, same mechanics, same signals. This isn't the end of the story. It's the early chapter, because the forces pushing this market didn't disappear today. They're still building. If you want to stay ahead of where this goes next, not after it's obvious, follow and subscribe. The next layer is already forming.